We are moments away from the start of trading, 22 seconds to be exact, until the opening bell. And we're looking at kind of a mixed picture in terms of futures. S&P futures are down as the indexes closed lower yesterday, although we did make a record high on Wednesday. I think it's interesting to look at the gain in NASDAQ and Russell 2000 futures, especially the tech stocks are being driven higher by hopes for more AI gains. Alibaba, the Chinese company that trades here, though, really boosting those hopes in earnings last night. You hear the opening bell, the Downtown Alliance ringing the bell at the New York Stock Exchange. Have no idea what that is. But Universal Logistics, which is a trucking company, one of the dudes there has an awesome beard. Shout out to that beard. And the stock had tripled over the last 5 years until it came plummeting down over the past couple of months and now is only up 62%, which is better than a stick in the eye. Speaking of, Katie Greifeld, what do you see in terms of the major averages?
You know, Matt Miller, you used to have an awesome beard, but I see you've been leaning more towards the mustache. I have mixed feelings about that, but we can talk after we get through this opening. There's not too much to talk about, though. The S&P 500 down about 0.1%. We're just about flat on the week. With this small move, we might be biased towards a negative reading for the weekly gain, but we'll have to keep an eye on that one. Big tech, as Matt mentioned, that has been the outperformer. You have a lot of optimism building over Chinese tech, that rally becoming impossible to ignore. That's been lifting some of these U.S. tech giants, but some of that momentum fading right now in the first minute or so of trading. And then you take a look at the small caps. The small caps have been all over the place following the bond market, but at least for right now, the Russell 2000 is your leader, up about 0.9%. Meanwhile, let's take a look under the hood. We've been following this story. United Health down after the Wall Street Journal reported that the Justice Department is investigating its billing practices. United Health just sent an emailed statement which calls that report misinformation. Now, according to the article, attorneys are looking into how United Health records diagnoses that trigger extra payments to its Medicare Advantage plans. You can see the shares currently off by about almost 11%, Shonali, if you round up.
Yeah, seriously dropping this morning. Not dropping, though. Celsius, it is up almost 30% at the market open. It's going to be buying energy drink rival Alani Nu for $1.8 billion in cash and stock. The deal comes as Celsius's revenue growth has slowed, including year-over-year declines in the past 2 quarters. This was a stock that took a big beating last year, but has now turned into positive territory at least this year.
All right, and I'm focused on Rivian, warning investors that Washington policies with EVs, the changes to those policies, could impact sales this year. And yes, it makes some very expensive vehicles that don't get the tax credit, but it was hoping to make a cheaper vehicle that would. The company reported its first ever quarterly profit growth. It anticipates modest growth for 2025 with the emphasis on modest. I think they want to make a maximum of like 56,000 vehicles this year after making 49,000 last year, which is still kind of child's play.
Yeah, it's not very much compared to some of the more traditional.
But they look awesome.
They do look pretty cool, and I see a lot of them on the road for how few that they're making.
Have you driven one?
I haven't driven a Rivian.
And?
I don't like the fact that when you take your foot off the gas pedal, the car stops.
Okay, you can change that.
I know, but it's not my car, so I can't.
Oh, right, okay.
Yeah. Anyway, I don't own a Rivian. Let's broaden out this conversation, because sitting next to me, we have Threadneedle Ventures founder Ann Berry joining us on set on this Friday. Ann, it's great to see you in person.
Thanks for having me.
We love having you because you get specific.
Yeah.
And you're always here when there's big news, it feels like.
I feel that way, yeah.
The big news, one of the big single stock stories this week is Walmart. Of course, shares falling about 6.5% yesterday. That was its worst one-day decline since November 2023. You saw some sell-side notes come out and say, maybe this is a dip worth buying, and Ann, I know you did that.
Yeah, I totally bought into this. I love Walmart, and here's why I think this is the moment to go in. The world that Walmart described is a world that's probably going to have tariffs, is probably going to have a consumer feeling a tighter squeeze, and that's the world in which Walmart does really well and takes share. 2/3 of what Walmart sells actually comes from the US. It's gained enormous traction with the high-income consumer. So I think if what it predicts is going to cause its growth slowdown is ultimately a world in which it gains share relative to other retailers as well. So I like that.
Normally, I'd want to harp on the consumer for a long time. It's my favorite story, as you know, in the
I
market.
would also harp on U.S. production. I mean, even the stuff that comes from the U.S. is probably just assembled here with parts that come from
Matt
overseas.
is my favorite Matt.
Okay. Nerds are my
Anyways,
mortal enemy.
I know this. I know,
Yeah.
which is why I love calling you one. Anyways, Palantir. The reason I want to talk about it, it's been such a big contributor to the NASDAQ 100. It has been down 2 days in a row to the tune of 15%, rebounding today. This defense story.
Yeah.
They wouldn't be the only potential loser, though we've been talking about it's hard to see Alex Karp losing out, even if the Defense Department were spending less.
Peter Thiel has a closeness to this administration. it
Very
feels like.
close. What do you think it all means at the end of the day for a stock that has run up so much?
Well, I want to start with this idea that being close to the administration equals some benefit. Let's take Tesla as a case in point. There is no one closer to this administration than Elon Musk, and yet Tesla and the EV sector taking a hammering around what could be happening from a policy perspective. So I would kind of separate
And
this-
yet Elon
those
Musk's
out.
wealth has grown considerably since the November 5th elections.
As a result of a lot of his other investments, yes, right, including perhaps X going back to its original basis, its cost basis. But when it comes to Palantir, I remember being on this show actually right after the election results, and you looked at me and said, Anne, what do you think of the Trump trade? And I remember saying, I think the definition of the Trump trade could be turned on its head because of the existence of Doge, because things like defense that would traditionally be seen to be advantaged by having a more hawkish administration, on the flip side of this, this cost-cutting focus could actually be really detrimental. And I think Palantir is now the canary in the coal mine from a market perspective. And the market is saying the Doge effect potentially is going to overcome a fundamental policy effect and a hawkishness in this administration.
It's interesting. I'm looking at Tesla since the election as well. It's up 40%.
That's not a bad return on investment.
You want to
4 months?
How much Palantir's up since then?
How much?
170 or 160%.
So there you go. I
Canary
will
in the
note
coal mine.
that Tesla is down 12% year to date. To just illustrate how fickle this seems to be.
And take a look at their sales too. And look at their sales in Europe. So I don't think yet that we've seen the full impact on Tesla. And I think these are the kinds of stuff. It's almost become a meme stock, right? There's a separation between the fundamentals.
Yes. I mean, it's been a meme stock for a decade, right? Tesla.
Some would have said that Amazon, therefore, was a meme stock for a decade. But actually, I think there's a different long-term play. But I think it's become one now, yeah.
What fundamentally do you think are the soundest investments out there? Is there a stock where you get up in the morning and you're so pumped about it, you can't wait to sing from the mountaintops?
I hope there is never a stock that I wake up so pumped in the market. I think
Shanali
from
went
the
to bed
mountains.
thinking about the 10-year yield. I'm not
really
kidding.
did, and
Yeah.
he didn't let me write that into my newsletter this morning. But
Good.
yes.
That's good. Okay, wait. Well, we
Don't admit
shouldn't be
that.
living our lives. Look, Walmart is one of them, but I think there's a couple of others. When I think about the financials, at the moment, I think someone like a JP Morgan is really well positioned. I think these enormous balance sheets. I think within interest rates still where they are. With relatively stable GDP growth, with international presence, I look at something like a JP Morgan and say, I think this is going to be, a long-term stable play. I also happen to be a massive fan of Jamie Dimon, so like fangirling a little bit here with this.
Okay, JP Morgan year to date, guys. I mean, it's interesting. Up another 11%. This is a stock that hit a record high. What gets you there? Is it just the love of M&A IPOs? Because January was actually a really weak month for both. And IPOs have not come back. In fact, we've been talking about it all week. Many have been slumping after they've gotten out the door. So what brings it there? Can it just be deregulation or lighter regulation alone?
I think there's a little bit of that, but there's also one thing that I think is interesting as a broader asset class. We are going to see a lot of corporates hit maturity walls. If you think about the credit issuance that happened prior to COVID, this is one of the reasons I think private credit has been such an interesting and compelling area for investment. The big banks with the big balance sheets, particularly in a regulated world, lending out at a higher interest rate before over the next 2 years, I think could be really interesting.
That is really interesting. So seeing more opportunity potentially on the private side. I mean, when you're putting together your portfolio, what does the division look like between public and private at this juncture?
Right now, my activity is heavily skewing towards private. I've said this now for a while. I think the public markets are extremely expensive.
Right.
Risk premium negative in some cases. The private market's offering a couple of interesting moments. A lot of companies that raised capital in 2020-21 are now having to go out again. And I'm seeing a breakdown in some valuations for some businesses that are fundamentally pretty good, where there's opportunity to go in.
Do you think we could see a correction? We're looking at the NASDAQ 100 now turn negative on the day. It's one day, but it just shows we've been sitting here watching the market really try to break into the green most days this week.
Yeah, but you hope we could see a correction, I'm sure, right? I mean, if you think it's overvalued and you want to get in.
Yes, I hope, and I think we are overdue a correction. Yeah. If we look now at what's going on what are the catalysts for there to be continued growth, right? Maybe it's rates coming down, but guess what? That's belated. That's been priced in for a long time. Is it GDP growth kicking up another notch because of tax cuts or deregulation? I don't know. Not on the flip side, if you take Palantir as the example where some of these, there's unintended consequences. So I don't see what the catalyst is for a further boost. The one thing I can think of is if the international markets can get it together, if Europe gets stronger again, if Asia gets stronger again, and that fuels holistic global growth, maybe. I don't see it right now.
All right, Ann, it's great having you. We could go on. We should have beers after. This is a conversation we could
Celsius, coffee, it's still
if you want.
9:30 a.m.
I feel like beers are pretty healthy. Ann Berry there. Thanks so much for joining us. Coming up, United Health defends its billing practices on news it's facing a DOJ investigation. The shares are down 9%. This is Bloomberg.
Welcome back to Bloomberg Open Interest. A look at stocks. We are 14 minutes into the session, and you can see that losses deepening when it comes to the S&P 500. We're probably now in negative territory for the week, with the S&P 500 down about 0.2%. That enthusiasm that we were talking about in tech fading as well, with the NASDAQ 100 turning negative as well. And then you take a look at the Russell 2000, those small caps trying to hold on to gains. We were higher by about 0.8% just 14 minutes ago. Now down to about 0.1% gain. We'll keep an eye on that one. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, we have Blue Owl, no longer a sell over at KPW after reporting a solid Q4. The firm says that it's more confident that Blue Owl can trade in line with sector valuations. That's worth a 1% gain. Next up, we have Cantor Fitzgerald downgrading Rivian, saying it's no longer a buy after a disappointing fourth quarter. The firm attributes the downgrade to lower vehicle deliveries, the impact of potential tariffs, and the uncertainty of EV tax credit. Shares down about 5%. And finally, we have Akamai Technologies, no longer a buy over at Piper Sandler after the software company gave a weak outlook. The firm says that the results show, quote, messiness ahead and low growth. Akamai now the biggest loser in the S&P 500 today. Matt Miller.
All right, down 13%. Of course, we're also looking at big losses for United Health, the second biggest loser, I think, right now, after news that the Department of Justice is going to probe the company on payments or payments not made. The company calling the headlines misinformation and reverberating through health care stocks regardless across the board. Bloomberg's Danny Berger is here with more. This can't have been unexpected, right? I mean, ever since the murder of the United Healthcare CEO, there has been a lot of talk about which claims are approved and how many are not. And the fact that the government, especially a populist government, looks into this has to follow.
Well, I'd say especially this case specifically, Matt, because the Wall Street Journal for some time has been running kind of this investigative series about United Health and these practices. This is more about what they're telling the government they're getting in terms of certain diagnosis. This is a Medicare Advantage plan. The idea of it is half the people who are on Medicare do it through private Medicare Advantage. They send all their data to the government and say, hey, here are all the diagnoses we've had under this plan. Please send us money accordingly. So if they have more diagnoses of a certain kind, they will get more money from the government. The Wall Street Journal again had this investigation saying nurses, software, a variety of things were basically over-diagnosing people. So then United Health could turn to the government and say, you owe us more money for diagnoses which maybe shouldn't have been there. To your point, Matt, United Health saying to Bloomberg, it's misinformation. That story from the Wall Street Journal, rather, which we have also matched ourselves, and saying it's not aware of any new activity in this regard.
Now, I also want to pull up some of the criticism that is percolating around what is happening right now. Bill Ackman, in particular, who has been pretty vocal about what has been going on here, says that when a company, in this case United Healthcare, attacks its critics, the probability that it has committed fraud or guilty of a crime increases substantially. And here he calls it a psychological short that he has on United Health. He says he would avoid the stock. He says when you find two cockroaches, it is almost certainly that there are many more. Now, this has been a heated debate. I know, Katie, you've been watching this too. United Healthcare has shot back at Bill Ackman as well. So this has been a argument here between the investor.
Super smart to get into a Twitter argument with Bill Ackman.
That's the way
great PR.
Policy happens through X now, Matt. I hope you know. So the government is watching and listening. He had this tweet. He's now since deleted it, basically saying there was an operation happening and it was stopped mid-operation because they had to call the insurer. Again, we don't necessarily know the veracity of that because he did delete it. Not only that, United Health has been investigated by the DOJ on antitrust terms too. There's so much negativity around this stock, and this again just adds another layer to
around the industry.
Correct.
There's a lot of negativity around this industry.
I don't believe United Healthcare has responded to the current Ackman tweet, though you're right that this argument has been between previous.
Yeah, and I do love that Ackman calls it a psychological short, since we know that he's not really in that business much anymore. Let's talk about the spillover effects, though, because it's not just United Health that is falling sharply today. You take a look at CVS, Elevance Health, Humana, et cetera, all these other insurers falling as well, which is interesting because you could say that this is pretty specific to United Health, but traders just seem nervous.
I think, though, one of it is we have to remember the kind of environment we came into 2025 with politically. This idea that it would be deregulation, that M&A would be happening, it would be an easier environment for corporations. The M&A hasn't really been there, and we're seeing all this action from the policy side that's been hurtful for these companies. United Health is just another instance of this. You can also look to Howard Lutnick yesterday talking about cruise operators and not letting them get away with some of the tax loopholes they have.
Right, and tankers.
Correct. It is a market that is now being dictated by political policy. And again, this has tinges that I think will surprise people because they thought it would be a lighter touch when it came from the DOJ.
Danny, thank you so very much. What a long morning you've had. Very amazed by your encyclopedic knowledge of what has been going on this week. Anyways, coming up, traders who cut their teeth during the 1980s rise of the junk bonds are now the winners of the private credit industry, which is minting billionaires. That's next in today's Wall Street Beat. This is Bloomberg. And it's time now for the Wall Street Beat. Today's Big Take looks at how the rise of private credit is shaking up the ranks of billionaires on Wall Street. And look at just the 5-year stock moves of Ares and Blue Owl, which have minted 8 billionaires, according to Bloomberg's data. Bloomberg's Ben Stupples co-wrote the story, joins us now. It is just pretty incredible. I remember covering Blue Owl when it started. They were one of the earlier Wall Street unicorns, and now they, I believe, are larger in market cap than even Carlyle. Certainly Ares is as well. So they've grown really fast in a short amount of time. What's more stunning is the amount of billionaires, as we've been talking about. How was all of this wealth amassed?
It's interesting. Thank you, Shanali, for having me on. If we remember back in the pandemic, we had Eric Yuan as sort of the poster boy, I would say, of that sort of period. In this age, when we've got interest rates higher for longer, the wealth is amassing there. Look at the share price you just had up on the screen for our viewers. I mean, the share prices of these companies have more than tripled since 2022, when the Federal Reserve started starting interest rates for the first time in years. So in this different age that we're living in, these are the new sort of poster children, poster boys of this, I would say, the macro picture that we're having at the moment. They're reaping the biggest benefits and making a lot of money for other investors too.
Yeah, just looking through the list here, I think poster boys is a fair term. I don't see any women on the list. Are they not involved in this, billionaire minting madness?
On the list, yeah, you're right, Matt. You're right. There's actually no women. These men are all white. Actually, all pretty incredibly well educated. Made me feel quite inferior. I think the Golub Capital founders.
Well, you've got a
have,
British
I think,
accent.
About 6.
At least.
That gets me going, but those guys, for example, have 6, I think, degrees between them. I think it's a byproduct of maybe the industry, how it's changed. A lot of these guys have been, yes, they've got rich in the last maybe 10 years, 5 years or so, but actually they've been at this for 30 years, some of them, maybe even 40. So that's the change. If you think about what Wall Street was like 40 years ago, that's when they started sort of crafting their trade, and they haven't stopped, and now they're really reaping the gains.
Yeah, well, let's talk a little bit about what this means for the pipeline, what this means for the talent war that we talk about all the time on Wall Street, because you note in your story that all but one are in their 50s and 60s. But I have to imagine that some of the young bucks on Wall Street are reading articles like this, seeing how much money you can make in private credit and saying, hey, maybe I should pivot.
That's especially true. I think if you are in a big Wall Street bank right now, and yeah, you're there thinking, I'm highly regulated, I'm working in this space, and some of these firms that we're writing about today started out as sort of spin-outs from some of the Wall Street giants that we cover every day. I'd certainly be there if I was then thinking, gosh, I can get a higher performance fee, higher management fee, and maybe some other sort of performance incentives that would be better for me as well. If I'm outside this sort of more regulated space in banking, I go into private credit. Of course, private credit is such a catch-all term for other things as well. You could be in a private equity company that's traditionally known for buyout deals over the last 2 decades, for example, and you could shift into private credit. So the sort of transferable skills that you're seeing, I think, across Wall Street are fascinating.
Matt, it's pretty interesting. Ares, I just looked, is not only bigger than Carlyle, it's 3 times bigger than Carlyle by market cap. Arrighetti is in his early 50s and leading a lot of that rise. And
he's young.
Young, and also the amount of headcount they have for a $50 billion company. It's 3,000 people for a $50 billion company, less than 700 for Blue Owl at a more than $30 billion company per headcount market
Speaking
cap.
of Arrighetti, what's coming up next week?
Excited for that interview. We are going to Ares to talk to their new co-presidents. Perhaps billionaires are close to it as well, I'm sure. And Mike Arrighetti in an exclusive next Thursday.
Yeah, I'm psyched for that. I love the whole private credit space. It's the Ozempic of big banks. And Stu, thanks so much for helping us cover that. Coming up in the next hour, SailPoint CEO Mark McClain joins the show following his company's IPO this week. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Let's take a look at these markets right now with the S&P 500 at session lows down about 0.3%. You can see big tech not too far behind with the NASDAQ 100 down about 0.2%. A rally building in the bond market. 10-year Treasury yields down about 5 basis points. Let's see if they react to this data that we're getting right now at the top of the hour. University of Michigan sentiment, the final read for February, coming in light relative to the prelim. 64.7 is your final read. The preliminary read was 67.8. But let's train our eyes on the inflation portion, which comes in pretty much as expected on the one-year inflation expectations, 4.3% for the final read. The final read for longer-term inflation, though, that 5 to 10-year look ahead, coming in at 3.5%. The preliminary read was for 3.3%. So let's break it down now with Michael McKee. What do you make of these numbers?
Well, obviously, the headlines about tariffs and other potential price increases brought on by the new administration seems to be feeding into this a lot. We saw a big jump in the one-year number when the preliminary came out. It went from 3.3 to 4.3, but the 5 to 10 didn't change. Now 5 to 10 is moving up as well. So people are really internalizing the idea that prices may go up, and that's something the Fed doesn't want to see. Last couple of days, we've heard from a lot of Fed officials who've said one of the things they're watching is to make sure that inflation expectations do not become unanchored. This is a 1 month, 2 readings, but 1 month view. Does it mean they're becoming unanchored? We're going to have to wait and see a little bit longer, but we have seen market-based measures, break-evens rise. So there is a feeling that we're going to see prices higher.
Yeah, I've been keeping a close eye on those break-even rates. Sonali, I will say it's interesting that the knee-jerk reaction here seems to be buy long-dated bonds if you're worried about long-term inflation.
You know how I feel about this. Something inside of me is dying. And, you know, Mike, the thing about this is when you look at the consumer feelings around inflation expectations, is that worry here that consumers are going to drag the economy down to some degree?
Well, we're seeing that reflected a little bit in the markets also because of the S&P Global Manufacturing and Services PMIs that came out about 15 minutes ago. They were lower than anticipated. The manufacturing a little bit higher, but services drops to 49.7, below 50, below the expansion level. And so there's a concern that maybe the consumer is going to be pulling back. We had those bad retail sales numbers earlier this month, and it may be that consumers are tapped out in January, or it may be they're getting concerned and so they're going to pull back. And that's something the Fed is going to be watching very closely.
With the drop in the 10-year yield, by the way, it's yet again a week where the 10-year yield has come down under President Donald Trump. Every week that he's been in office, it has come down a little bit.
It's still higher than 441. That was the first time that Bessent made that 10-year comment. That 441 level is my new kind of calling
We're like a sneeze away, though.
We're close.
Mike, I want to ask, I don't care about this University of Michigan stuff, because if you look at it divided by Republicans and Democrats, they just cancel each other out. What do you think about the Mar-a-Lago Accord that has been talked about yesterday because Jim Bianco had a meeting, but apparently, who was it, Stephen? Mirren has brought it up, and it all centers on Zoltan Pozsar's research. Everybody loves a little Zoltan Pozsar research, right?
Hard to get now. Research expensive, I hear.
On sort of redistributing the costs for global defense by in some way getting foreign bondholders to swap out their treasuries for longer dated bonds.
Yeah, I forgot to bring my tinfoil hat out here, but I think that I would put it in that category because there's a couple things that go into this theory that just make no sense at all. Why, if you were a sovereign country, why would you swap out bonds you're holding that pay you interest for 100-year zero coupon bonds?
Well, you'd have to get them for cheap, right?
You'd use ChatGPT. Just for fun, I plugged in, why would you buy, why would you make this swap? And the ChatGPT said, you wouldn't. And that's basically it. And the theory is that because we pay for the defense and stationed soldiers in these countries, that they owe us, and they should do it for that reason. But that's not correct, because some of the countries do pay. South Korea pays us over $1 billion a year to station soldiers there. Germany pays for all the bases and upkeep over there. So,
which isn't much, by the way.
It isn't much anymore, but Trump's also talking about pulling troops out of Germany. So at this point, there isn't really a motivation for that. And the other part of it is revaluing the dollar. that is a very dangerous road to go down. We saw that in 1995 when Lloyd Bentsen, the Treasury Secretary, suggested the yen was overvalued, and then we had to go way into a currency crisis almost, and then Bob Rubin with the strong dollar stuff. Those are difficult moves to make without setting the market off. You can't control them.
So I think you're 100% correct. How do you get them to swap? You've got to offer them a sweet deal. The word force was used in the story, which I don't see how that works out. But also, Liz Capo McCormick, who wrote the story, she's like a genius. So I wonder, how do you get the trade-weighted dollar down and still keep, as she suggests, the Bloomberg Dollar Index higher?
I think that feeds into the wild speculation part, you know, and maybe the tinfoil hat that Mike was talking about.
That's why I love it so much.
That's fun.
You know what? We're going to talk about this. I see Allison Schrager out there. We're going to talk about this with her because I think it's pretty fascinating. And she has a great column out on Bloomberg Opinion.
She's smiling, so I feel like she has something to say.
On the Trump administration maybe making some of the same mistakes that the Biden administration made. Right now, thank you very much for that, Mike. I want to bring in Maria Waitman, State Street Global Markets Head of Equity Research, and try and make sense of these markets. We just hit a new all-time high on the S&P on Wednesday. We've had very little volatility in the bond market, with yields just floating ever so slightly down each week since President Trump took office. What do you make of this, lack of concern, lack of alarm when it comes to policies that are sometimes a little bit too crazy to imagine until they're enacted?
Yeah, I think that's a really good question. Fundamentally what we had is, we need to turn the clock back only, 6-8 weeks to kind of beginning of the year when everybody were very bullish. Everybody was kind of thinking that U.S. exceptionalism, U.S. economy is soft landing, economic growth is fine, earnings are strong, inflation is coming down, no signs of de-anchoring, volatility is low, everybody bullish. That's where the big positions. And I think markets kind of survived that. Volatility is still low, corporate earnings are broadly fine, inflation is not getting out of control in a major way, so we're kind of ticking along. I think that's kind of the story, and we're getting increasingly, at least in the data we observe, as market getting some tariff fatigue. I think that's probably the best way to describe it, is market are less sensitive to the kind of the tariff rhetoric now.
Yeah, tariff fatigue definitely is sort of the name of the game here. It feels like they're just losing their shock value, these threats. I want to talk about American exceptionalism in the context of the equity market, because we've been talking about it all week, the fact that you actually have Europe outperforming the U.S. year to date. We'll see how long that lasts. But what I find fun is that if you take a look at ETF flows into European ETF strategies, you're really not seeing much. It feels like ETF investors basically aren't wowed, aren't impressed, and they're not putting money behind this trade. What does that say to you?
Yeah, I think there is a little bit, we know that European fundamentals are weak, right? So that's kind of the starting point. So European corporate earnings are weak. We know that economic growth is slow. We're not enough fiscal support, not enough monetary support. And that was a trade for, last 20 years. But European stocks are very, very cheap. And now we're having this hope, expectations that the war in Ukraine will be finished, which would be amazingly fantastic. But so far, the deals we've seen, the kind of conversations we've seen between U.S., Russia, Ukraine, to some degree, Europe, they're not likely to bring the lasting peace in Europe. And to my mind, that's really not something that you reduce risk premium on. It's something that you increase risk premiums. So I have to say, I do come from Eastern Europe, so I think that's really not a kind of strong peace settlement in there. So.
What about the idea that, if Donald Trump and the United States of America abandon Europe, which it kind of looks like he may, given his back and forth with Zelensky and his closeness to Vladimir Putin, what about the idea that Europe actually comes up with some money, like real size, to support Ukraine, to support their own defense, invests in military, rearms itself? Isn't that, a Reagan-esque story that would drive growth?
I mean, yes and no. I mean, if Europe really, Europe really need to come up with money and spend. And I mean, we had the Mario Draghi report, and I would probably argue there are more kind of constructive way to spend money in Europe in terms of kind of fiscal multiplier and kind of industrial policy than spending on defense. I mean, arguably over last 30, I don't know, since the end of Cold War, last 40 years, we had peace dividend in Europe and the whole world kind of benefited from it. Now we're kind of rolling back. So, I mean, to me, that's some skepticism. But to add to Sonali's point on ETF flows, so what we see in State Street custodial database, institutional investors are selling every cyclical sector in Europe. Yes, they're buying financials, and that's a trade that's been going for some time in Europe, and that's arguably where majority of returns are, and they're buying defense stocks. But overall, kind of underlying cyclicals, we don't see investors buying them. So similar to the ETF flows you're showing.
I think it was Katie's point on the ETF flows. I think we're going to talk more about ETF at the end of the 10 o'clock. But, Maria,
which is fascinating, by the way, because I guess we're going to have Balchunas on, or
no,
Athanasios Sarafagis.
We're having Vildana Heinrich on.
Vildana, okay, but the idea...
She's better than the two of them combined.
The idea that we were talking about at the meeting is that American investors aren't putting any money into Europe. It's European investors that are
no one cares about Europe except for Europe. That is the story of the ETF flows.
Back to the United States, back to American exceptionalism. Maria, what do you think about this idea of a potential correction? There are a lot of people who look at the U.S. markets and say, we are standing at fragile heights. Do you think a correction is necessary, overdue? How would you categorize it?
I mean, we're definitely standing at fragile point, and but arguably we've been there for quite a while, right? So we know that U.S. stocks are crowded, we know that U.S. stocks are expensive, we know they are relying on like a small group of companies to drive profits. But I mean, that was true for most of last year, and we continue to make new highs. I mean, to me, this increased market uncertainty, tariffs, political conflicts, potential. I mean, they all argue for sticking with quality stocks other than rotation into like small caps and value. And arguably like small cap and value trade, what they need lower interest rates. Are we going to have a big decline in interest rate? Probably not. I mean, we know that cutting cycle is likely to be shallow. So I'm very skeptical about small caps. That's probably my kind of pet hate. I think this trade is very, very challenging. So I'm sticking with quality. And I think quality leads you to US mega caps.
Yeah, there you have it. Breaking my heart on the small caps, but Maria, it's always great to talk to you. Going around the world with Maria Waitman of State Street. Have a great weekend. Now, coming up, economist Allison Schrager explains why she thinks President Trump risks making the same economic mistakes as Joe Biden. That conversation up next. This is Bloomberg.
Let's get now to high interest. Look what's making headlines around the world. The U.S. Senate confirmed Kash Patel to lead the FBI. Patel has promised to overhaul the agency. President Trump has repeatedly claimed the department has been weaponized against him and other conservatives. Patel promised not to politicize the FBI, though, and says his top priority is protecting constitutional rights. An ex-Tesla director is denying a report by the FT that he is leading a Japanese group encouraging Tesla to invest in troubled automaker Nissan. The former board member took to X, which is Twitter, to deny his involvement and said that he's unaware of any interventions by the Japanese government. And score one for facial hair. The New York Yankees are breaking with their long-standing tradition of banning beards. The controversial policy was ushered in by the Yankees' late former owner George Steinbrenner. Yankees managing partner and general partner Hal Steinbrenner said he spoke to a number of current and former players before arriving at the decision. In a statement posted to X, which again is Twitter, he says, "We will be amending our expectations to allow our players and uniform personnel to have well-groomed beards moving forward." So I guess I could play for the Yankees now.
There you go, Matt Miller.
Is this well-groomed?
It looks nice. I mean, I might clean it up a little bit, but I think you're in business.
Thank you. Oh, Treasury Secretary Scott Bessent says that regulation was a massive contributor to the rise in inflation during the Biden administration. He sat down with Bloomberg Surveillance yesterday.
What really happened under the previous administration was you created a demand shock with government spending, but it was met by supply constraints as there was more regulation. In Trump 1.0, we created a demand shock with tax cuts, and it was met by a supply-side response of less regulation.
And then the COVID pandemic happened. Joining us now for more is Bloomberg opinion columnist Allison Schrager. Her latest piece, Allison wrote that Trump is risking the same economic errors as Biden, and it's basically you don't get something for nothing. There's no free lunch, right? Biden wanted to, rain trillions of dollars down on the American people, and without inflation, obviously that didn't work out very well. You say Trump risks making some of the same mistakes. How?
Well, it's the same fatal conceit, this idea that you can get something for nothing. You can make arguments, national security arguments for tariffs, but, they are going to cost consumers and producers more. They do tend to sort of contract growth. You just don't, or even when you were talking earlier about the Plaza Accords, the idea that we can restructure the whole financial system and it won't cause dislocations. Or even with the tax cuts, I think they will increase growth. I think deregulation will also be great for growth, but there are always trade-offs, and I feel like more and more, maybe I wonder if it's sort of a hangover of the low interest rate environment that makes people believe things are free. It's worse than normal of people arguing, oh, we can have this thing and we won't have to pay for it.
You think about the cuts that are being made, say, through the DOGE efforts, right? And you think about this financial magic that we're talking about. Scott Bessent spent a lot of time yesterday talking about just the math, budget math. What would be the least painful to cut in this economy that won't suppress demand to a point that you're starting to worry about growth in a more meaningful way?
Well, you'd have to really understand the inner workings of the government, which I don't. But in theory, and I don't doubt this, there's sort of inefficiencies everywhere. I don't know if this is true, but they argue there's people working for the government who aren't very productive and aren't doing anything. They're doing things that don't really add anything to economic value, and in fact might even stand in the way of especially a lot of regulation and red tape. And this has been a big issue in Europe as well, that stands in the way of growth. So in theory, cutting that should be almost a free lunch. Although, not always, because regulation reduces risk, which, there's a trade-off between growth and risk too. So I think the one thing I'm noticing a trap the Europeans are already getting into is trying to think, oh, well, we can deregulate, but we're also not going to have more risk. And that doesn't work either. There's always a trade-off.
Well, every action has a reaction. It sounds like what we're talking about here, but not to be pessimistic, but isn't this just the way that politics work, that you promise free things and you try to get elected?
That's true. Remember the supply-siders in the 80s, where tax cuts pay for themselves, but it's worse.
The Laffer curve.
Yeah. they've taken it up to 11 lately. And I think it might have been just the low rate environment or this belief although I think it's contentious whether we understimulated in 2008. But so now people are just completely like, we can give everyone $1,500 and we can just make that all debt financed and nothing bad will happen.
I wanted to ask about 2008 because you bring it up in your column yesterday. I recommend people go to Bloomberg.com and read it. What did Ben Bernanke do wrong, or what did the U.S. Congress do wrong? I remember seeing him on 60 Minutes talking about deflation, and they asked about inflation. He was like, that doesn't matter. Like, we can control inflation at the drop of a hat, and clearly.
Well, I think the wrong... So when QE came out, like a lot of economists, myself included, were like, this is terrible. I still hate QE. But they also paid interest rate on reserves, and that made it less inflationary. So I think then the lesson was, wow, we can do QE in any amount. I mean, they did a large QE, but then they did a really, really big QE around the time of the pandemic. So I think it was also a problem of scale, of just this belief, well, if we do something a little, we can do it a lot, and there won't be any cost.
Allison, we thank you so much for joining us here on set today. Of course, as Matt has been saying, read her column. It is very thought-provoking. I would also recommend Anna Wong's column today at Bloomberg Intelligence about the 333 plan. Some
that you
analysis
can't get it all
there.
done. You can have maybe 2, but probably not all 3.
Exactly.
Is there anyone who thinks that it's possible to do all 3?
Scott Bessent?
Right.
I doubt it. Like you said, that's how politics works. You promise something.
Anyways, still ahead, energy drink maker Celsius getting a pop after announcing buying rival Alani Nu. Details on that next. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Chipotle is hiring 20,000 additional employees in the run-up to burrito season, which apparently runs from March to May. It's just 2-month long. It's relying on some AI to handle some of that hiring, but one company that's not expanding, Hooters of America. It's in talk to prepare a bankruptcy filing in the coming months.
Still exist?
Apparently it does, but maybe not for much longer.
Wait, we don't have any graphics or VO for Hooters?
No, we don't. Let's move swiftly along and talk about James Bond movies undergoing a major shakeup after creative rights for the iconic franchise were sold to Amazon. The studio will now control who plays 007 when the next film goes into production. And finally, Celsius Holdings announcing it will buy energy drink rival Alani Nu for $1.8 billion in cash and stock. This deal expected to close in the next few months, and it comes as Celsius's revenue growth has slowed, including year-over-year declines in the past 2 quarters. Fascinating to see this surge in shares right now. We're looking at the CEO right now, who's probably a very happy man. He'll join us next week, Thursday at 10 a.m. But if we go back to the shares, up about 24%. Usually when you see a big acquisition like this announced, you see the acquirer shares go down. Not the case, though, for Celsius right now, currently up about 24%. Meanwhile, coming up, we'll speak to a different CEO, and his name is Mark McClain. He is the CEO of SailPoint, a recent IPO. Looking forward to that conversation. This is Bloomberg.
SailPoint is back on the market. The security company went public for the second time last week. The first time it went public back in 2017 before Thoma Bravo took SailPoint private in 2022. Thoma Bravo, of course, has been very much looking for this IPO market to open back up, and SailPoint is a critical part of that. For more on the decision to go public, again, we're joined by Mark McClain, SailPoint's CEO. When you spoke to our colleagues over here at Bloomberg News, you talked a lot about the use of proceeds, the grand ambition here about going public. At the end of the day, what do you think the first priorities are for you? Is it paying down that debt or looking for expansion opportunities?
I think the primary was to pay down debt, Sonali, but I think we see ourselves kind of as a long-term growth business. So in some ways it was putting some fuel in the tank, as it were, and kind of getting ourselves ready for what we believe is a multi-year growth opportunity. So yeah, it was kind of get the debt down to a manageable level and then get ready for future growth.
I do want to talk about the timing a little bit. Of course, this is your return to the public markets. You listed on the New York Stock Exchange in 2017. Then you went private when Thoma Bravo acquired you in 2022. Now you're back again, which is a pretty quick turnaround. Just talk us through that.
Yeah, I think, to be honest, Katie, and by the way, just a piece of data, you probably know, we were owned by Thoma Bravo before the first IPO, so it's a little bit of a back and forth thing, not a terribly common story, I guess. But I think we were kind of, when we did the go private in 22, thinking of a little longer time frame to come back. And I think two things are true. One is we've been forced to have a very good, amount of growth over the last few years and kind of shifted to a more profitable profile. So that kind of desirable scale, growth, profit profile that markets like. And then, of course, the markets have warmed up a bit, obviously, in the last 3 to 4 months. And so I think it was that combination of being ready, having kind of a hopefully attractive profile for the public markets, and then kind of ready to pull that trigger when the market started to warm up, and we felt like the time was right to do that.
You can tell your story, Mark, with your growth, and Wall Street likes to see the numbers, but in terms of just the elevator pitch, I always find it so difficult to understand what these software solutions providers do. And in your notes, it says you equip modern enterprise to seamlessly manage and secure access to applications. Like, what is that?
What does that mean?
How do you tell your butcher what your company does?
I usually say my grandmother, but she's deceased, and probably the butcher is a better metaphor. I think at the end of the day, there's what everybody does all day, every day, and they get this, is they log into systems, right? We all have a whole bunch of accounts and passwords, so everybody gets that concept. What SailPoint's focused on is ensuring that in an enterprise, a mid to large scale enterprise, where there might be tens or even hundreds of thousands of human identities, and now increasingly what we call non-human identities, think software programs, and now AI agents is all the rage. All those identities have access to systems and data, right? That's generally some kind of an account and a password. Well, keeping all of that accurate and what's called in the security realm least privilege. In other words, any identity should have exactly what they need or it needs to do the job and no more. Well, keeping that accurate and adhering to security policy is really hard. And that's what big enterprises have struggled with, because all those systems are from different vendors, right? They've got Workday and Salesforce and ServiceNow and Microsoft apps and Oracle and all kinds of stuff from 20 or 30 or 50 years of IT. And getting all that to stay in sync and to be secure and accurate is a very hard problem. That's what SailPoint's focused on, is the right access to the right data for every identity in their enterprise.
I'm glad you bring up AI. I've been asking ChatGPT to log into some of my applications and do some stuff for me, right, rather than just answer stupid questions. And so far, it can't. Are you going to enable that kind of technology? How soon do you see that kind of thing being able to work?
Well, there are some places, your ChatGPT, Matt, is, doing this to you, as I guess it should. Yeah. But I think at the end of the day, there is a sense that people want to automate and streamline things while maintaining security. And that's the tension, right? There's a tension that's existed forever in the realm of technology, which is convenience and things go fast and easy is what business users want, and control and security is what kind of the protection mindset people want, right? So there's always a tension there. And AI is just, in some ways, the latest, maybe most dramatic iteration of, wow, super cool tech, we can do a lot with this, we can accelerate our business, go do amazing things, and the security folks are going, oh, tap the brakes, like not sure exactly if we understand what access to what data is happening here, and all these controls we put in place to protect our business and its information might be getting run over in that realm. So there's a tension there, and we're pretty early, obviously, in this dynamic, right? So we're one of the companies that's kind of in the thick of that with all these providers of business application technology and LLMs and AI models and all that good stuff, and then these security professionals in these enterprises that are trying to make sure they let their business succeed, but do so in a way that protects its information. And that's just a hard problem, and we're kind of at the center of helping big enterprises solve that problem.
You know, Mark, on the show, we like to have our guests talk about their business, but also about their market experience. And you got a lot of credit here for being one of the first to market this year. Of course, this is an IPO market that a lot of investors have been waiting to open back up. The first week has been choppy. What would you say to people that are looking to go public right now? Is it a good time? Is the window really small, frankly?
It's such a good question. We've wrestled with it both. I will give you a little perspective that, you know, everybody's got their view of what's happened, even in our case, for about a week now, right? I mean, we priced kind of between 19 and 21 on the cover of the S1. We raised the filing range from 21 to 23 and priced at the high end of that range, and then upsized our offering. So we did a lot of things that kind of said we weren't set up for a big run up. We were focused on getting out at the right price in the market to kind of balance two things, frankly, right? Thoma Bravo, our primary owner, wants good liquidity out of the deal, and we want to set ourselves up for long-term market success with a lot of the same long-term investors that own SailPoint for 5 years in the market before. So there was some tension there. And again, I like to say, if you're in my seat, you didn't do this for a one-day pop or even a week pop. We're thinking months and years of business success. You know, I won't plan on necessarily this kind of multiple. We went public the first time at 17 at a little over $1 billion. We sold to Thoma Bravo less than 5 years later for $7 billion. So we think we understand something about how to grow once we're in the market, and we just don't focus on the day-to-day. A semi-famous phrase I developed on our first public offering timing was to our own team internally. I said, look, every second you spend watching the stock price, you're doing nothing to help the stock price, right? Like, watching stock movements day all day is what you all and a bunch of investors do. Our team's job is to go build great solutions and win in the market. And I always say, if we do that well, the stock price will take care of itself.
I hear what you're saying. If I were the CEO of a company, I would just stare at my stock price all day. So I really respect the discipline there. I do want to get your thoughts on the broader landscape, the broader competitive landscape, because you're the first cyber IPO in quite a while. I believe the last one was Rubrik back in April. Do you think that your debut may encourage some of your peers to come out of the pipeline and test the public markets?
I think there's, and beyond security, Katie, but I think all around the market, people have been kind of watching and waiting. Is it time to get back out there? And like I say, depending on how close you are to our story, in our minds, we thought we were going to come out at the midpoint of our original filing range of 20. We've been trading in the 24-25 range. So in our minds, that's great. And we think we're going to, over time, be able to move up from there if we continue to deliver results. So I think people were watching us, watching kind of the market receptivity. You know, can't comment on the volume or the level of this, but it was kind of reported that there was an oversubscription thing here, meaning there was a lot of interest in the investor world. I think the market, as you all know, has been hungry for some more IPOs. So I think there's an interest, and they're looking for the right profiles of companies. And then I think back to your question a little more, Katie. I think at the end of the day, cybersecurity is still a very good market, right? If there's nothing else that's true, everybody's very well aware we are far from solving this. Matter of fact, we will never solve cybersecurity, right? It's just a cat and mouse. There's going to be new ways of tackling it. You know, a very common question we get is AI good for you or bad for you? And I say yes, right? Like, welcome to cyber, right? It's going to be a tool that helps us do what we do better, and it's going to help the bad actors do what they do better. So we're just going to continue to be helping companies protect themselves against a set of bad actors, nation states, criminals, et cetera, that are trying to disrupt them, steal data, you know, et cetera. So I think we're very confident that this is a great market. And then within that, back to Matt's question of explaining this to your friend the butcher, right? Identity is a very interesting subsector of security because it's probably the newest subsector, meaning for decades we've been working on network security and device security or endpoint security. You know, we know names like Palo Alto, we know names like CrowdStrike and all that. Identity security is a relatively newer concept, right? There's a handful of names there And the market got a little enamored with this single sign-on thing, which is kind of all the rage a decade ago. And that's an important piece. It's far from the comprehensive need, though, that customers have to secure their enterprise and all its data. So I think we're still maturing. We're still maturing in this market.
All right, that's a good place to leave it. Mark, great to get some time with you. Hope to speak to you again soon. That is Mark McLean of SailPoint. Meanwhile, a quick check on these markets trading at session lows right now. The S&P 500 now down about 0.6%. You take a look at the makeup here. What is dragging it down? On a points basis, your biggest loser today, your biggest weight to the downside is United Health, falling on that DOJ probe into Medicare billing. Stock down 8.6%. On the upside, we have Booking Holdings currently higher by about 4%. That is your biggest points contributor to the upside, but not making too much of a difference when you consider you also have Amazon, Microsoft, Tesla, all lower today right now.
You're now on track to have the S&P down about 0.5% for the week, and so some of that exuberance after record highs being seeped out of the market.
Booking is actually adding the most points to the S&P, which it's only a $170 billion company. Usually you see the Mag 7 on both sides of that barbell, right? So it's telling that they're the leaders. I want to talk about Rivian for a second because the shares are tumbling today, and obviously this is a stock that's done absolutely horrendously since it went public, losing 84% of its value. We were hoping for, I think, 56,000 deliveries in 2025. They've now said that they'll deliver between 46,000 and 51 and change, which is obviously nothing for a car manufacturer. And they blame a host of problems, the tariffs and the EV regulation. I don't understand why I think it's a production issue. Like, why can't they sell more of these super cool vehicles?
Do you think that the demand is there? I mean, we talk about all these different factors.
More than 50,000.
Perhaps, but I don't know. EV demand, when you think about the charging issues that we were discussing in our morning meeting, it's just, difficult to charge.
And even bigger than Rivian, you see Tesla down significantly, as you've been saying, on the year. That's dragging now the Mag 7 into negative territory for the year. And that is a pretty stunning thing to see after what we saw last year.
All right, coming up, we're going to have more on the auto sector. President Trump says he will impose tariffs on car imports. We'll explore what it means for the auto industry next in today's Wall Street Week.
All right, it's time now for our Wall Street Week conversation, and automakers bracing for President Trump's proposed tariffs on Mexico and Canada. Wall Street Week host David Westin investigates how the 25% levy could make your next car more expensive.
If you look at the landscape of the auto industry, it represents about 5% of GDP. It's about $1.2 trillion of activity, with almost in the case of manufacturing and parts, that represents about 2 million workers.
Ellen Hughes Cromwick is a senior fellow at Third Way and spent much of her career as the chief global economist at Ford before serving in the Department of Commerce under President Obama.
There's no question that tariffs raise inflation.
S&P Global Mobility estimates that the average $25,000 price of a car imported from Mexico or Canada could go up by $6,250 if tariffs take effect. The 50 best-selling models in the U.S. market account for about 60% of the market volume, half of which would be directly affected by the tariffs.
The importer pays the tariff, not the company that's exporting to the United States. So number one, that business has a choice to make. Either they pay the tariff and import the goods, or they begin to substitute away from those imported product and try to find other sources. They could also pass along that increase in their cost because of the import tariff to their end market customers. And it, in general, will just simply raise prices.
The hit the auto producers may suffer from tariffs is already being seen, not only in their stock prices, but in their being less profitable than their suppliers for the first time in 6 years. And RBC calculates that it will be the U.S. producers, GM, Ford, and Stellantis, that will be hit the hardest. Imposing tariffs on inputs to any products made in the United States will increase costs. But in the case of tariffs on auto parts crossing the Mexican or Canadian borders, the problem is particularly acute, given the complexity of the supply chains and the need for parts to cross the border several times over the course of production. Everett Eisenstadt served as the deputy director of the National Economic Council under President Trump during the last term, where he has seen trade sentiment go from integrated to protectionist.
So the 25% tariff would have a pretty disruptive impact on the integration that has been ongoing now for a couple of decades. And it would be quite a dramatic shift, I think, if that were to go into effect for a sustained period of time.
And that was today's Wall Street Week. You can catch the full show tonight at 6 p.m. Eastern. Really interesting conversations there on the automaker industry and potential tariffs. One of the interesting points that David Westin made was that automakers expected to be less profitable than their suppliers for the first time in 6 years. You consider the impacts here, and that really puts it in stark contrast.
Yeah, absolutely. I mean, suppliers got to make money too at some point.
That's true.
But one of the biggest problems with tariffs is none of these cars assembled in the U.S. are made with all American parts. So it's not just going to hit cars that are imported from Germany or from Mexico or from Canada, as so many of them are, Korea, but it's going to hit cars that are assembled here with parts that come from all of those places, and China as well.
I think Bessent was the man of the week in many ways, and he was talking about car affordability, housing and car affordability. If that's the case, if they're worried about this, then how do tariffs conflict with another key concern at the administration?
Yeah, I mean, there's some estimates out there that these tariffs could increase car prices by $3,000. That's definitely going to lead to some sticker shock, but...
And they're already very expensive, right? That's the problem with any additional inflation, is that we've already seen so much.
You know what else is expensive? The debt used to finance those cars as well. It's painful.
Interest rates are high. This is Bloomberg. Well, Wall Street is trying to capitalize on the private equity boom. Now, while actual true private asset ETFs are still awaiting regulatory approval, many issuers are churning out products that claim to replicate PE exposure. Let's talk about it now with Bloomberg's Vildana Heinrich reporting on this trend. You, in your headline, called this the Bud Light of private assets coming into ETFs. What exactly does that mean?
That was a great quote that I got from one of the people cited in the story, Todd Stone over at Strategis, where he said he was looking at some of these ETFs that have been coming out in recent months that are aiming to offer PE-like returns. And so what he called it is Bud Light, because it's sort of watered down. Because these ETFs aren't actually holding private assets, they're trying to, they either are following indices that are trying to mimic PE-like returns. A lot of them are holding small cap companies. Some are holding large cap companies. One of them is holding Meta and Google parent Alphabet. So hence that quote.
So it's a good excuse to really look under the hood, a good reminder that you have to know what you own when you're buying into an ETF. But there are some ETFs that do actually hold private companies. You mentioned XOVR. That's the ticker. We were debating how to actually pronounce that. Zover, I think. That holds SpaceX, correct?
That's right. And so the point with that one is it's been seeing a ton of inflows. It's seen 130 million come in just year to date, so in the past 2 months basically. And so what that suggests is there is demand for private asset stuff, but that potentially investors, and especially retail investors, might want to actually hold the real thing. So this ETF holds, has shares of SpaceX. And so that might be really enticing for a lot of retail investors who might not be able to get their hands on private assets in other ways except via ETFs.
Vildana, one of my favorite white papers of all time is this AQR paper that looked at small caps looking to mimic private equity returns through leverage. And this is what these ETFs are essentially doing. The outcome of this paper, is that there is an illusion of lower risk here, an artificially smooth return stream. So basically more risk here with not significant outperformance to public equities. How are they supposed to beat what has been previously found?
One of them has been around for just a couple weeks. PEVC is the ticker. It's actually outperforming the S&P since pretty handily, actually, since it launched just a couple of weeks ago. A couple of the other ones are underperforming the S&P, or even if you look at the Russell 2000. What the issuers will say, though, is, again, this is just an easier way for investors to access these types of returns because an ETF is easy to buy and get out of. You're not locking up your money for long periods of time. Plus, we all know ETFs come with much lower expense ratios than what you might get otherwise. And so maybe those are two arguments for someone who really wants this type of exposure, right?
What are your favorite white papers? Not just this year, but like all-time white papers. Do you have a top 5 list, or?
Can I plead
really
the fifth
on
this one?
Here.
XOVR is crossover.
Yeah.
That's how you pronounce it.
Well, I'm not going to say.
I thought it was Zover also.
Crossover.
Yeah, crossover, but XOVR. Yeah, it means it's an acronym for crossover. But how do you pronounce the acronym?
X is everything.
Well,
I see.
To bring it back to the PE funds, one of them is LQPE, which is liquid PE, so it's a good ticker.
By the way, Bud Light has 4.2% alcohol.
It's not bad.
Real Budweiser has 5%, and then like good beer,
But you know what
6,
people
7,
want
8.
is levered Bud Light, right?
You just don't get as drunk.
You don't go for the 9%, 11%?
Yeah, that's my point.
Like, we are up against the clock. I have a newsletter to promote. Vildana, I'll see you back at the desk. Bloomberg's Vildana Heinrich. Great reporting as always. Tune in to ETF IQ every Monday at 12 p.m. Eastern, and you can read all about the ETF industry in my weekly newsletter. That is Bloomberg.com/ETF IQ newsletter. We do have a promo for it, but we're not.
Will you put your top 5 favorite white papers?
I probably won't. I probably would struggle to think of 5.
Satoshis.
Oh, God.
I like the AQR Berkshire Hathaway white paper. That's very in vogue right now. Anyways.
Coming up on Monday on Open Interest, Jack Janasiewicz joins us from Natixis and Rebecca Patterson of CFR.